Hi, I'm John Persinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, February 27. To view our full range of trading services and publications, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. Allow me to introduce one of my favorite contrarian indicators, cable television news. In particular, the celebrity pundits on the financial advice shows. Case in point, on February 9, CNBC's Jim Cramer opined price stability is right around the corner, adding that the Federal Reserve was closer to winning its battle against inflation than Wall Street thinks. Cramer suggested that an imminent dovish turn on monetary policy would lift stocks. When I heard Cramer's words, I thought to myself, goodbye, Fed pivot. Sure enough, over the past 2 weeks, we've gotten terrible news on inflation, raising odds that the Federal Reserve would go higher for longer. The government reported last Friday that the Personal Consumption Expenditures PCE price index in the U.S. climbed to 5.4% on a yearly basis in January from 5.3% in December, surpassing consensus expectations of 4.9%. Stocks tanked on the news. The week before, the January numbers also came in hot for the consumer price and producer price indices. After a powerful rally to start the year, markets in recent weeks have gotten volatile and pulled back. See the following table. The Dow Jones Industrial Average is now in negative territory year to date. The yield on the 10-year Treasury has risen past 3.94%, which puts the brunt of the pain on growth stocks, particularly in the technology sector. That said, the Nasdaq is still hanging on to a decent year-to-date gain. The Fed's current tightening campaign has caught Wall Street off guard, largely because of the extraordinary circumstances fueling inflation. Forget the false narrative that government spending has boosted inflation. The real culprits are insidious because they're unprecedented. Pent-up demand following the post-COVID reopening of the economy, which created global supply chain disruptions, supply shortages, and rising commodity prices, all factors exacerbated by the Russia-Ukraine war. Fed tightening cycles create headwinds, of course, but investors over the past several months have been compelled to continually reset their expectations on monetary policy. The unique circumstances in play can't be found in textbooks. The good news is that inflation is on a downward slope. However, prices aren't cooling as fast as investors are hoping. Inflation has peaked, but it's proving stickier than expected. Yes, the end of this hiking cycle is getting closer, but the Fed still has more work to do. I'm still bullish over full year 2023. The economy boasts many positives, including a resilient consumer and job market. But expect plenty of bumpiness ahead. Paradoxically, bad economic news would, for Wall Street, constitute good news. Slower wage growth, fewer job openings, and a rise in the unemployment rate would be necessary before the Fed stops boosting rates. Wall Street expects a few more 0.25% rate hikes in the coming months, followed by a pause during which the Fed will hold its policy rate at around the 5% mark as Fed officials parse the effects of higher rates on inflation and economic growth. The rate is currently in a range of 4.50% to 4.75%. It was virtually zero a year ago. After the latest spate of disappointing inflation data, an economic soft landing is increasingly improbable. We'll probably see a short and shallow recession in early 2023, followed by green shoots of new growth and more bullish conditions in the latter part of the year. You should feel confident enough to buy on the dips and stick with your long-term portfolio strategy. Now let's take a look at the week ahead. Keep an eye on the following economic reports scheduled for release in the coming days. Durable goods orders and pending home sales, Monday. S&P Case-Shiller U.S. House Price Index and Consumer Confidence, Tuesday. ISM Manufacturing Construction Spending and Auto Sales, Wednesday. Initial Jobless Claims, Thursday. And ISM Services, Friday. This week's data will give us clues as to whether the economy continues to run hot or whether the Fed's rate hikes are starting to show the desired disinflationary effects. In the meantime, my colleague, Dr. Joe Duarte, has developed a way to generate cash for his followers despite the risks I've just described. As chief investment strategist of our premium trading service, Weekly Cash Machine, Dr. Duarte leverages a fear-based algorithm that uncovers instant cash codes that could generate up to $1,600 per week in extra income, regardless of geopolitical events, Fed policy, the path of inflation, or other adverse macro trends. In fact, Dr. Duarte's methods actually thrive on market volatility and insanity. For details, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. Also, if you have any comments or feedback, please don't hesitate to send me an email at mailbag@investingdaily.com. Thanks for watching.